The one big beautiful bill that most Americans who are celebrating the new tax cuts have no idea about the massive underlying changes that are coming to their healthcare, student loans, and retirement benefits. Here's exactly what we're going through. First, I'll show you the permanent tax changes, the rates that are now locked in forever. Then we'll cover the new temporary deductions through 2028, including the no tax on tips and overtime provisions that everyone's talking about. From there, we'll break down the massive business owner benefits, including a deduction that is now permanent and the ability to write off additional deductions against their income. We'll also cover the healthcare changes affecting Medicare and Medicaid, the education restrictions on student loans, and the complete flip in our energy policy. I'm Bob Wolf, a certified financial planner and IRS enrolled agent who's digested the tax code to help individuals navigate the complex tax situations that they face every single day. Before we dive in, important to note that this is strictly educational content and should not be misconstrued as specific tax or legal advice. Always consult with a qualified professional who knows your specific situation before making any financial decisions. So with that being said, let's jump right into it. All right, let's start with the provisions that will impact almost everyone that's watching this. Lower tax rates from 2017 are now made permanent. This is the permanent extension of the individual tax rates from the Tax Cuts and Jobs Act in 2017. This is literally the most expensive provision in the entire bill, putting over $2 trillion back into taxpayers' pockets over the next decade. Now, the 2017 tax cuts reduced several tax brackets. The 39.6% bracket came down to 37%, the 25% dropped to 22%, and the 15% fell to just 12%. These tax bracket deductions were originally temporary and were set to expire at the end of 2025, but this bill makes these reductions permanent. For individuals, this might be somewhere around 2 to 4% tax savings across the board on all income. Second up is we have a permanent extension of the increased standard deduction, which about 90% of taxpayers claim at this time. The 2017 tax cuts more than doubled this deduction, but that temporary increase was also set to expire at the end of 2025. This bill not only extends this deduction, but it also makes this permanent. This change alone is projected to save taxpayers over $1 trillion over the next decade. Next up, we have the estate tax and gift exemption, which is doubled permanently. Here's something that didn't get much attention, but is huge for wealthier families or those who are building their wealth. The estate tax exemption has doubled to $15 million per person or $30 million per married couple. This was supposed to drop back down to around $6 million per person, but now it's permanent at the higher level. This means only the wealthiest families will ever have to pay 40% of estate taxes. Those of which who are in that range where they're closer towards the higher level will have a little bit of a sense of relief after knowing this. The bill also makes temporary upgrades to several deductions which taxpayers can take advantage of for the next few years. The first temporary deduction is the state and local tax deduction, or the SALT deduction. Prior to the bill passing, there was a lot of controversy about the SALT deduction, which allows for people to write off their state and local taxes on their federal income tax return. The 2017 tax cuts capped those write-offs at just $10,000 for itemized deductions, which negatively impacted many taxpayers in high-tax states like New York, California, New Jersey, and so on. Because if you paid higher than $10,000 in state and local taxes, then you were unable to write off that additional amount of expense on your tax return. This bill temporarily increases the cap to $40,000 through the end of 2029, which will make the itemized deduction more beneficial for millions of taxpayers in high tax states. But that's not the only temporary upgrade here. This bill will also allow taxpayers to write off up to $10,000 of their car loan interest on qualifying new vehicles through the end of 2028. Now, this would only apply to newly purchased American-made vehicles and would be subject to income limitations depending on your filing status. And if you do qualify for this, you will be able to take this deduction even if you do not claim the itemized deductions. The reason for this is because the vehicle deduction is set to be something that is called an above-the-line deduction. So let's take it back and talk about how taxes are made. Effectively, you have your gross income, that is the first number, minus any above-the-line deductions. These are things that are newly represented in the new interest vehicle deduction, which then gets us into our adjusted gross income. Once we have our adjusted gross income, then we have the option to choose between the itemized deductions or the standard deduction to get to our taxable income amounts that then flows through the tax brackets. Another benefit that we have here is that if you have children, you may benefit from the enhanced child tax credit. This is another provision that was set to expire at the end of 2025, which would have caused the child tax credit dollar for dollar savings to go down from $2,000 to $1,000 per qualifying child. This bill extends this and increases that credit to $2,200 per child, which is expected to save taxpayers nearly $800 billion in taxes over the next decade. Now, this credit will continue to phase out based on your income, starting at $200,000 for single taxpayers and $400,000 for married taxpayers. This bill also creates a new senior deduction for individuals over the age of 65. This is separate from and in addition to the standard deduction. Prior to the bill, seniors were entitled to a small additional amount added to their standard deduction. This bill creates a brand new deduction of $6,000 for each qualifying individual over 65, which is subject to income limitations based on their filing status. For retirees, this is significant because it's on top of your regular standard deduction. So if you're married, both over the age of 65, you get your regular standard deduction plus $12,000 in additional deductions for being seniors. Now, while we're speaking of deductions, let's address the no tax on overtime and no tax on tips provisions that get a lot of attention during the campaign. Despite the name, all overtime wages will not be exactly exempt from taxation. What this bill does is it allows certain individuals to take a deduction against their overtime wages, which will effectively result in no tax on that portion of their income up to certain limits. This bill will grant single taxpayers up to a $12,500 deduction against their overtime wages and married individuals up to $25,000 of a deduction against those same wages. And this deduction will also be subject to income limitations, beginning to phase out for single taxpayers with over $150,000 in taxable income and over $300,000 for married taxpayers filing jointly. There are similar income limitations for no tax on tip provisions in this bill as well. This bill allows a deduction against qualified tip income up to $25,000 and is subject to the same income limitations that we just went over. And qualified tips, by the way, is defined as tips received in an occupation where an individual customarily and regularly receives tip income. This will apply to employees and certain business owners that provide hospitality services, personal care, transportation, and certain creative and retail services as well. However, specialized service trades or businesses do not qualify for this, like doctors, lawyers, accountants, dentists, or really any business where the reputation or skill of the provider is the main thing that people are paying for. And speaking of businesses, let's address some of the biggest tax provisions in this bill for business owners. First is the permanent extension of the qualified business income deduction, which will literally save business owners billions in taxes over the next decade. The qualified business income deduction was originally introduced in 2017, which granted qualifying business owners an immediate 20% additional deduction against their qualifying business income. For example, a business owner with $150,000 in qualifying income would get an additional $30,000 tax deduction to use it to offset that income and presumably reinvest into their businesses and continue to grow the economy. For individuals earning below a certain threshold of income, they would automatically qualify for this deduction as long as they had some form of self-employment income, even if that's just a side gig, whether it be through an S corporation, a partnership, a single member LLC, or just a unincorporated business like a side gig, for instance. Then this deduction starts to phase out for certain types of higher income business owners with specialized trades and businesses. But not all business owners are actually subject to those income limitations. Prior to this bill, this provision was going to completely expire at the end of 2025. This is yet another deduction that we are making permanent through the law as it stands today, and is a common theme that we're sensing through this bill. Plus, it increases the income thresholds to qualify by $25,000 to $50,000 depending on your filing status, which will allow certain high income earners to qualify for this under the new rules where they did not under the old rules. In addition to the qualified business income deduction, there's another big tax incentive in this bill for business owners: the permanent extension of bonus depreciation. And this is huge. Bonus depreciation grants an additional tax deduction against tangible business or investment property, like vehicles, machinery, equipment, furniture, fixtures, tools, and even things like aircraft and yachts. Prior to this bill passing, this deduction was limited to just 40% in 2025. But this bill increases this rate back to 100% for all qualified purchases made after January 19th of 2025. This will allow many business owners and investors to make strategic purchases that may help them earn more income while reducing their taxes at the same time. These are just some of the major changes for business owners, but this bill will also permanently extend 100% research and development expensing as well, which will allow any business that is developing or improving upon any product, process, technique, formula, or software to write off 100% of qualifying research and development expenses, as opposed to receiving a partial deduction. Yet another tax break made permanent is the Opportunity Zone tax credit, which has allowed investors to defer and avoid capital gains taxes when they're making investments into qualified Opportunity Zone funds, which have a lot of qualifications behind them. Now let's talk about healthcare changes that will affect millions of Americans. For Medicare, physicians are getting a 3% temporary payment increase for 2025 under the new physician fee schedule, which should help with doctor availability and access for Medicare patients. However, the bill also expands orphan drug exemptions where Medicare price negotiations, which means certain specialty drugs won't be subject to Medicare's price controls. This could potentially keep prescription costs higher for retirees and individuals than originally expected under the Medicare negotiation program. As it relates to Medicare's cousin, Medicaid, there are significant changes coming. The bill requires states to establish work requirements for able-bodied Medicare recipients. It also restricts Medicaid eligibility based off of their immigration status. So starting in fiscal year 2027, federal Medicaid funding will be limited to U.S. citizens, lawful permanent immigrants, Cuban, Haitian entrants, and specific refugee categories. Healthcare providers will face significantly more administrative requirements for verification and documentation of patient eligibility as a result of this. Outside of healthcare, another major area that our tax laws impact is our education system. And this bill makes federal changes to education funding that will affect millions of families. The bill establishes loan limits for graduate and professional students and terminates Grad Plus loans entirely. Parent borrowers also face new limitations, with specific amounts to be determined by the Department of Education. At the time of recording this video, it's expected to be capped at $100,000 total for graduate borrowers and $200,000 for professional schooling. The message is clear on the education front. Federal borrowing for higher education is getting much more restricted, which will leave us looking elsewhere for funds or how to go about bridging the gap for those of us who are looking to borrow. On the flip side, the bill also implements accountability measures where colleges with poor graduate employment outcomes could lose federal aid eligibility entirely. So a lot of things to watch out for on the healthcare and student loan or education front. Next up, we have energy policy that's taking a complete reversal. This bill creates a dramatic shift in energy policy that will impact utility bills and investment portfolios alike. Let's start with clean energy programs getting eliminated. The bill rescinds unobligated balances from multiple clean energy programs, including the Greenhouse Gas Reduction Fund. They're eliminating funding for clean heavy-duty vehicles, diesel emissions reductions, and environmental justice programs. As a result of this, there is a traditional energy enhancement that we are leaning towards now. At the same time, they're expanding oil and gas leasing requirements and reducing regulatory barriers for traditional energy development. So if you work in renewable energy, federal support is disappearing. If you work in traditional energy, oil, gas, coal, you're getting enhanced federal support. So what does this all mean, and what do you really need to do about it? For retirees, now that we have extended and made permanent our historically low tax rate environment that we are currently in today, consider Roth IRA conversions while rates are locked in where they are. Budget for potentially higher prescription costs, especially specialty medications. Take advantage of the new $6,000 senior deduction if you qualify, and review your estate planning with the certainty of the $15 million exemption per person, and just determine if anything needs to get done there. For families, make sure you're getting the full $2,200 child tax credit. If you're in a high tax state, optimize the SALT deduction timing while the $40,000 cap is available through 2029 to help you save even more. For business owners, plan equipment purchases to maximize the 100% bonus depreciation. Review your current entity structure to optimize your qualified business income deductions, and consider timing major investments around these permanent benefits. The bonus depreciation is permanent, so you have time to plan strategically on that. But the sooner you act, the sooner you could get the cash flow benefit. For everyone, work with a tax professional who understands these changes. Many specific dollar amounts are still being determined by the Treasury and other agencies. Take advantage of temporary deductions through 2028 and prepare for when they will expire. The writing's kind of on the wall for us to be trying to be bridging the gap of where we are from a government spending and a government revenue side of things. And certainly, this tax cut did not help the revenue side. This bill creates clear winners and losers. Winners include business owners, traditional energy companies, farmers, and retirees. The challenges fall on clean energy workers, graduate students, and people dependent on government benefits. The key insight here is if you understand these changes and can plan ahead of them rather than looking backwards, you can position yourself to benefit regardless of which category you're in. The opportunities are significant for those who act quickly and strategically. Most provisions are effective now, with temporary benefits running through 2028. Some restrictions phase in over the next few years, and specific dollar amounts for many provisions are still being determined by agencies. If this breakdown helped you understand what's actually in this massive tax bill, subscribe for more details and tax analysis. I'll be creating an in-depth guide for many of these provisions, so make sure you're subscribed to stay in the loop.